Welcome, everyone, to the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Thursday, December 4th. It's 2:25 p.m. Mountain Time. So this is another installment of Investment Friday, and I am joined by my good friend and Chief Investment Officer of Juncture Wealth Strategies, Brad Haines. Brad, what's up? How you doing?
Not much, doing really, really well. Doing well now that the federal government's open and we're getting more economic data. So that's been fantastic.
Yes. Is there snow behind you?
Um, so no, well, yes and no.
Okay.
So we've had a little snowfall. None of it has really stuck, but there are parts like on certain rocks where it rarely gets sun that you'll get a little snow cap on that. Um, but no, Utah is waiting for our first really big snowstorm of the year,
Oh, wow.
which, by the way, I bought skis this year and
You ruined it. You
I
are the
I jinxed
reason.
I jinxed it 100%. And so I apologize for all skiers who are going to come to the state of Utah and go skiing this winter. I may have just jinxed it.
Well, you can bring your skis to Flagstaff because Snow Bowl is open. Flagstaff got a ton of snow the last couple of weeks. Apparently, it looks great up there. They even got snow, I guess, yesterday. So everyone else is getting snow, just not Salt Lake, apparently. I'm so sorry.
Evidently, that's crazy.
Well, it is almost winter. We're right there, right? December. We're closing in on the end of the year. Lots of stuff going on. What data have we gotten from what was missing when the government was shut down?
Yeah, so we are getting back all of the data that they have done. Now, they canceled a couple of different announcements just simply because they can't get the data back. You know, a lot of the survey data where you can't go to a consumer and say, "Hey, how did you feel about your financial situation in September?"
Right.
No one's going to really remember that specifically. And so they've canceled a lot of those data streams. So they're just going to have to interpolate those data points once we get, a few more months in between. Um, but we've started to get a lot, a lot of the CPI, PCE, PMIs. In fact, the, uh, yeah, we've been getting a lot of we've been getting a lot of the data that we've been wanting to see, that we've been needing to see, particularly because next week, next Wednesday, is the Federal Open Market Committee that meets to determine whether we get another interest rate cut. And
Mhm.
so, having the labor market data, having the inflation data, really critical for those policymakers to be able to debate and come to a conclusion as to what to do. I personally think they're going to cut another quarter percent or 0.025% in interest rates. Um, and then I think they'll probably pause for January. So
So, which is one of the things I wanted to talk about a little bit today. The job market
mhm.
is that's some of the data that's been coming out that the job market is weaker than expected. Is that correct?
That's correct. That's correct. I mean, um, Christmas and Gray, which is an executive outplacement firm, they track a lot of the data points in terms of how many job layoffs have been announced. Now, there's a difference between announcing a layoff and executing a layoff and having those people go onto the unemployment rolls.
Hmm.
Okay. So when a company announces a layoff, it doesn't impact anything other than they've announced it. Okay. Then once they execute it, actually lay the people off, then it kicks on their severance. So depending on how generous the firm has been or the company's been, it may be a month or two before their severance runs out. If those people have not found a job during the time of the severance, then they start to hit the unemployment rolls.
Okay.
Okay. Oftentimes, though, a lot of those individuals, obviously, as you and I would be, is they are looking for jobs and they're trying to replace their employment. And so many times during that severance period, they get reemployed, and so they don't necessarily, um, yeah, they don't necessarily do that. So,
They don't hit the unemployment rolls. So that sounds
yep,
like it's more of a leading indicator rather than a lagging.
correct, correct. So it's something that's a bit of an interesting dynamic there.
So, is there anything else that you wanted to talk about report wise or inflation wise or anything like that before we dive into our topic at
Well,
hand today?
last week or earlier this week, we got the ISM manufacturing data, and
What does
it
ISM stand for?
Institute of Supply Management.
Okay.
It's a not-for-profit economic research institute that collects a lot of data across the economy. Um, you'll you'll hear it shortened to ISM because we don't like to say very long words in my industry, so we always have acronyms. So we have ISM, and they came out and gave a report on the economy, both from a manufacturing standpoint and from the services standpoint. In manufacturing, on the blush of it, looked a little stronger. Production was up. Uh, Customer inventories are at a lower level. Um, you know, Tariffs are starting to kind of fade away as they get implemented a little bit. And all that seems very good, seems really good. However, it's also, if you look at the reasons why, production was up because they're running off the backlog they have. The backlogs have dropped. Consumers, their customers are unwilling to commit to more inventory until they see where the economy goes.
Hmm.
That's not a bullish sign. That's kind of a little bit of a, hey, let's take a look. Let's wait and see what happens. Um, That's one of the reasons that I think the Federal Reserve will probably lower interest rates, and I think they should. It's probably appropriate. We're still slightly restrictive in terms of monetary policy for the economy, and so we'll be at in my estimate, a about a neutral rate from a monetary standpoint once they lower interest rates by a quarter point.
Is there any consensus or forecasting? Is it shifting for additional rate cuts, January, March, middle next year? Has that changed significantly at all from the last time we talked about that? Right? That the
So
6 months out, up to
it
6 months out
has,
outlook.
because it used to be 4 or 5, and now we're down to 2 or 3.
Okay.
And I think one of the risks, and this is going to sound weird, but one of the risks for 2026 is that our economy actually is stronger than people anticipate, and that this softening is just that. It's just a little temporary softening, and that we're going to reaccelerate here into 2026, and which means they may not have any interest rate cuts next year. In fact, we'll be looking more back towards that inflation and saying, okay, why is this inflation still 2.5 to 3.5% when the stated target by the Federal Reserve is 2%, and they can go back to a little bit more of a hawkish. Now, I don't think that's going to transpire, but I do think it is a risk. Um, Reason I don't think it's transpiring is because, or it'll transpire, is because we're starting to see a scarcity of funds in the short-term funding markets. That's where banks finance themselves. It's where banks invest a lot of excess assets. It's where the Federal Reserve plays with their overnight repurchase agreements, and it's kind of called the plumbing, if you will. Um, but the Federal Reserve's um, overnight facility, lending facility, had almost got down to zero from about $2 trillion, went to zero because of the issuance. And now it's starting to come back because they're starting to see some difficult problems, illiquidity in some of those parts of those system in that system. So it's the Fed is starting to inject more liquidity in the short-term markets to make sure that the banking industry is functioning a little better. It's one of the reasons that they also said, hey, we're not going to shrink our balance sheet anymore. This may be the place where we feel comfortable with what's going on in the economy, and we don't need to shrink anymore. We need to keep it as is. So I think that's one of the motivating factors for that.
That's interesting. And I feel like that's a was that one of our favorite listeners, Bob, said once we're like in an econ 303 course over here. But my whole brain was like, oh wait, hold on. We need to explain what that is and what that is and what that is. So we can go, I think monetary policy is a good one to talk about sometime. We can break it down in digestible terms.
Yes,
Because
we
I think it's
can.
important. I think it's important for people to have an idea of how money flows through the system, what keeps it moving. Because, I say this in a lot of different ways. I think it matters energetically and logistically, physically. Money has to be able to move. It has to be able to move. And that's not, we're talking in very literal terms here, right? That's the credit that in 2008, 2009, one of the reasons that that crisis was so bad was because of a crunch in money movement. Money couldn't flow, right? As a very crude way to put it, right? It was like pinched off.
Yeah, it's true. I'll give you an example. Oftentimes people don't realize, and people do need to have a fundamental understanding of how banking and the monetary policy work and how that interplay between the two, because it affects their life every day,
Hmm.
whether they realize it or not. And I'll give you an example. Um, Commercial banks, the reason why the banking industry is so vital to to the economy is because that's who creates the money supply. Banks create money by increasing the amount they loan. Okay. And they have to reserve a little bit, but they create money by doing loans for clients or for customers. Okay. So if contracting the money supply that's contracting and expanding from time to time, it's really critical that banking is healthy and it does a good job, because it is the backbone of the system. It really is. Um, yeah, and it's go ahead.
Would you say that contracting or expanding in in more practical terms is if the money supply is contracting, lending isn't happening. Banks
It's
aren't
actually
lending.
shrinking. Lending is shrinking.
So there less lending is happening when the money supply is contracting, getting smaller. That means less lending.
Yep. And people could think about it back in 2008 through 2010, right? How hard was it to get a home loan?
Right.
Really difficult, right? You had to go through a financial colonoscopy to get any money out of a bank. Why?
Very invasive.
Yes, what it was. Why? Because those banks, they had a lot of loans go bad. And for a bank, if $100,000 loan goes bad, they get zero back. Like it goes bad, it goes bad. I mean, you might be able to foreclose on the house and sell it for a partial recovery, but you're never getting 100% back. Okay. You're
Right.
never covering that whole loan, which means you have a big loss. And that can, if it happens to enough banks and enough times, that can actually shrink the monetary base. It can shrink the money supply. Okay. And that's really bad because that leads to deflation, which we saw, right, in 2008 to 2010 in that marketplace for residential real estate.
Yep.
How great was the deflation? It was terrible. I mean, I lived in Phoenix. You
My
were in
parents
Ohio.
Yeah, my parents lived in Phoenix though.
Yeah, so we were like the ground zero almost for a lot of that issue
Hmm.
where prices were down basically 50% within 2 years. Boom.
Yep.
I mean, that is tough for a lot of people to stomach, but we were. That's deflation. Why? No more lending, money supply for that asset shrunk dramatically. Now, conversely, if you want to do the flip side, prior to that time, they were expanding the money
Way too
supply.
loose.
Yeah, way too loose. They expanded it so fast for the fixed level of supply in houses in Arizona. Housing prices went crazy and that money supply grew dramatically. And so again, I don't it's a pretty simplistic understanding of what happens there, but there's a lot we could talk about there.
Yeah. Well, we will let's do that. We'll figure out what are like the any other components in there, like the again, the pipes in the system. I think that's a really good way to
Yeah.
put it. Um, yeah, so we can
I also want to talk about it at a future level or in a future podcast. So this is a teaser for those of you listening and viewing is the difference between lowering interest rates and having lower yields on bonds.
oh,
So for example, they lowered interest rates on Wednesday. Why are mortgage rates not going down?
right.
And
Always
what?
an important one. Always an important
Yes.
one for
So
people
that
to
again
consider.
impacts our lives. If they lowered interest rates, why did the mortgage rates go up? That's happened before too. So I want to talk about that connection and why that happens.
Perfect. Well, we have got episodes set up. And you also before we go to um next piece, you were working on the 2026 outlook, right?
That's correct.
When is that going to be done? Where clients and
Uh,
is anyone able to receive that if they ask you for it?
2, 3 weeks, yes, absolutely. It'll be done in 2 to 3 weeks. I'm giving myself 3 weeks. I want it done in two, but I'm giving myself three
It's fair.
just in case. Um, but yeah, anybody can write in, send an email saying, "Hey, I'd love to have your 2026 look ahead for." And what we do in that is we go over the economy, we go over interest rates, we go over equity markets, fixed income markets, real asset markets. Real assets are any tangible assets like real estate, commodities, um, and then we go over some geopolitics and how that's going to influence, if it does, any of the financial markets or economies.
Beautiful. So watch out for that. If you're already a client of Juncture, you'll receive that. But yeah, that's something that you want to check in with and see what our good friend Brad here has to say about what's coming up. It's always really, really super helpful each year.
Yes.
Um, cool. So let's talk about one of the most asked about topics that I have been inquisitioned about lately, which is cryptocurrency. Um, is it a good piece of your portfolio? Should you have it in there? Like what's going on here? So people literally ask me about this at least every week, if not more often than that. And I had at least, was it three or four clients asked me about it recently because Bitcoin had a really bad month, right? Bad couple months. It was down more than 20%, I think.
30, 35, yeah.
Okay, more like 35%. And a lot of people were feeling like, oh, well, maybe I should buy some because clearly it's going to go back up, right? And so you and I have been having these discussions around, different types of cryptocurrencies and the discussion that's out there and the talking points that are out there. And this will not be a comprehensive conversation by any means.
No.
There's a lot that we can talk about, but we wanted to hit some of the high points that we've been communicating to clients recently. Because there is a from what I can tell, there is a lack of perspective of of the true like middle ground of what's good about it and what still doesn't make sense or what doesn't have how do we want to put this? Where there's when I see it when I look at it from like an integrity lens, not an integrity like you say you do what you say you're going to do, but an integrity lens of does this asset actually have four sides and no cracks and built on a stable foundation? I don't see the integrity of some of it. So we'll get into a little bit of that. But you take it away, Brad. What do you want to say first?
All right, first of all, is what is crypto? Okay, cryptocurrency is simply a a token of a blockchain. Okay, now what's a blockchain?
An anonymized token of a blockchain, right?
Yes, an anonymous, very thank you. It's anonymous, meaning no one knows you own it. Okay. Um, and that can be a good thing, can be a bad thing, just depends on who you are and what you're trying to do. But essentially a blockchain is just think of a block of wood that you effectively put your, someone's going to give you $100. Like I'm going to give you $100, Hannah. And so on one half the blockchain, I have $100 on there, and then, or 100, I should say, not $100, but 100. And I'm going to give it to you. And on the second half of the blockchain, I write Hannah and I give it to you. Guess what? You have 100 blocks. Okay. Well, that blockchain um, gets recorded on an online decentralized ledger, meaning every blockchain out there is has a list from beginning until now of who's owned it, when they owned it, and all of the details of those transactions. Okay. Now, again, it's anonymized, so no one knows who, who Mr. 123 is. They don't
Right.
know that it's you, right? That's your username. But again, it's Mr. 123 is recorded on there. So it's something that is really important in terms of understanding that blockchain, because a blockchain, once it's set, is immutable, cannot be changed. It is set, and the whole world can see it. Everybody can audit that blockchain transaction and history of ownership. So how do you know you own it? Okay. Well, in your wallet, which is an account, it's a private account for you. That's your account. That's where you keep your ownership to the blockchain, to that cryptocurrency. And you have a private key or password or that you can get in, and it unlocks your ability to use that cryptocurrency, whatever it is, whether it's Bitcoin, Ethereum, XRP, any of those different cryptos, or there are thousands of cryptocurrencies out there. So um, some are some have usage and some don't. But
Well, and
um,
that's a really important point to mention also because if you lose that key, then there's no recovering it, right? That was a whole thing, especially when Bitcoin was newer, people losing their number, not being able to find it, and who knows, they lost how much in value because they just couldn't log back into their account. Um, so
yeah, so
interesting
so one of
dynamic.
my favorite shows was uh, it just came out. Anyways, it one of the shows, one of the episodes was they had mined Bitcoin way back in the day, and they'd kept a bunch on there, and they kept it on a computer. Well, they tried to extract it off the computer, but they forgot their passcode, and it was like $5 million that they could have split between five guys. Anyways,
Whoops.
um, so yeah, if you lose it, you've abandoned it because there's no other proof of ownership. Okay. But it's based on this blockchain technology. Now, blockchain technology, it has more applications than just cryptocurrency. Right now, I'm going to skip all of those other applications. We can talk about those at another time. We're just going to focus on crypto for right now. But it's digital, it's decentralized, it's anonymous, and it's based on the blockchain technology. And I'm just going to make a comment. My camera never flicks off except when I'm on the podcast with Hannah.
So
I think
sorry.
I think it's the Zoom. I think it is. So
I don't know.
I
I,
apologize to everybody who's viewing
I think your
because it's
camera's haunted.
irritating. Um, so those are the aspects. Those are the features of it. Now, why would I use it? What can it be used for? I'm going to give you the pro case in my mind. The pro case is if you're going to transfer assets to people around the world, it can be done cheaply, quickly, and in place to people who just have access to a mobile phone. They don't necessarily have banks around them. Okay.
Mhm.
Which for a person in the United States, they're like, we have banks everywhere. Yes, you do. But there are lots and lots and lots of people that don't have
Billions.
yet, billions that don't have access to banks in their area. They have to walk or ride or catch a ride to a bank to make transactions. So if you want to transfer assets across the border quickly and inexpensively to your family in whatever country or your friends in whatever country, it's a quick way to do it and have them get it there. Um, Another really good use case is if you're a criminal and you want to transfer it anonymously, hey, it is a use case.
This is not a recommendation,
It's not a recommendation, but it's why it's almost like they used to use diamonds and gold. Okay, a
right?
lot of criminals, they would actually carry these gold coins or these diamonds to pay and to transact. Okay.
You get your
Well,
briefcase full of
yeah,
cash, right?
yep. So those are what they used to do. Well, cryptocurrency, because it's anonymous and because uh, people cannot figure out who you are, it's a great way to do that. Okay, it's kind of a non-brainer or no-brainer for a lot of those.
Well,
Um,
and before you go off of that too quickly, I want to like just remind people that that was pretty much the impetus for Bitcoin in the first place, right? It was part of, being able to buy things on the gray or black market, have it be, again, decentralized and anonymous. And that was mostly what it was used for at the beginning of its inception. And then people latched onto it that, oh, we want to have a decentralized currency, and that narrative started to be pushed for the next push in its elevation in price. The next piece, and maybe this is where you were going to go, is that they said Bitcoin has to be mined, and there are only how many? What is it? It's like 14 million
Coins,
something
yeah,
coin. There's only, this is not the right number. I'll look it up in a second, but there's only 14 million coins that can ever be mined. So if you buy a Bitcoin, you are buying a finite asset, because once we hit that number, it'll never, there's no more to be mined.
right.
And so
21 million.
how many?
21 million.
21 million. So 21 million is as much as you'll ever be able to exist in the world. And so people were like buying it like, oh, well, if I get it now, then I'm going to be part of the people that have it. And then I'll be able, it'll push the price up because demand, supply, right? Constricted supply means the demand is going to skyrocket, or my value is going to skyrocket. Well, talk about what happened after that.
So what people forget about that in the limited supply argument is that you can fractionalize coins.
Right.
You can buy, so today, you were mentioning today, you can go on Robinhood and buy $10 of a Bitcoin.
You can do
Well, a
$10
Bitcoin
a
right
week and buy
now,
your Bitcoin.
right? Bitcoin right now is $90,000 per coin. So clearly that is not one coin. They're fractionalizing the ownership, which again is kind of what the US dollar did when it dropped off the gold standard, which is why we had inflation, right? And effectively, that's exactly what Bitcoin is doing. You can continue to fractionalize Bitcoin almost forever.
Hmm.
It's just a mathematical problem. It's super easy to do. Um, and you can do it for every cryptocurrency. I mean, the number of cryptocurrencies, hold on, I'm gonna get the most updated um, because it grows every day. Yeah,
Right.
37 mil hold on. There are 37 million different cryptocurrencies as of July of this year. So there's a couple things with the supply argument. One, you can fractionalize every single coin, and two, you can just create new coins till your heart's content. Um, in the world, there are only 212 nations, and there are fewer than 212 currencies.
Right.
So that kind of gives you a perspective that cryptocurrencies, the creators have tried to jump on this trend, and they've created so many that it's almost like it's too much. It's just too much. I mean, 37 million is ridiculous, but
Right. So in that respect, like there's a constrained supply, right? That it's just it doesn't hold water anymore. It's what's interesting to me, and I mean, again, it has come down quite a bit. What's interesting to me is that argument, again, it propelled a lot of the growth because it was a big piece of the narrative for a long time. So people were like, okay, I'm going to buy it, all of that. And then when now, I mean, we're not the only ones who are saying this, that it can be fractionalized to the point of no return, right? Like there's no amount too small at this point that you can use to buy your Bitcoin. Um, and so with that argument, the price has still been staying stable-ish, even though we know that that's not true anymore. But then the market then will move in this, like drop 35%. And then we'll find out kind of behind the scenes that, this one big investor dumped a lot of it, or this one big investor bought a lot, right? So it's like,
yeah, it's a very concentrated market.
right,
There are a few really big owners. I'm going to use Bitcoin as an example. There are a few really big owners of Bitcoin that have owned it for a long time. And when they decide to sell, they're not liquidating Bitcoin to get into another currency. More likely than not, they're converting into the US dollar.
right,
So they're cashing out. So in my mind, some of those people are using it as an investment, a speculative security, and trading it. Okay, well, and good for them if they've owned it for long enough. They've got this massive return. Fantastic. Um, but it's kind of like you don't want to hold on to it for too long because there is no uh, functional value or intrinsic value of any of cryptocurrencies. There just isn't. If, like, for example, a commodity, I've had people consider it a commodity and talk about it that way. And it's not, it's a mischaracterization because a commodity has an use,
right.
has an industrial use in some form or fashion. Gold, jewelry, okay?
Oil,
Gold, money, oil, you can convert it into gasoline and use it. I mean, commodities are usable product, okay? Um, and currency is just that. Currencies are only based on what the relative perception of the other investments in that world. And so, which is why you see Bitcoin itself going up or down a lot. And they all go up and down together most often than not. Um, so it's just something that you have to be aware of, and you have to understand why you're buying it if you're going to buy it. It can be somewhat speculative. Um, and it's something that you don't want to have too much of, and you certainly have to understand that it could go down a lot in value. Okay.
Well,
Now,
and oh, well,
go
before we
ahead.
get off the currency part, I mean, that's what I want to double click on with that is that it started out as a currency. It started out, Bitcoin in particular, started out as a way to transact anonymously. And when you have a currency, it has to stay relatively stable or else you can't rely on it as a currency. If and we see that we've seen that in countries that are going through complete destabilization and their currency just completely goes out of whack, and now people are trying to carry around, some if a loaf of bread, we'll use dollars just as an example, cost $4, and now suddenly we go through this insane inflationary period and bread now costs $10,000. That has literally happened in different countries around the world.
Yeah, it happened
And
in Germany between World War I and World War II.
right, so you're like wheelbarrowing your like cash around just to buy food when before, you're like this doesn't even make sense. And so with Bitcoin as a currency, it can't function as a currency anymore because I'm not going to, say like, yeah, I'm going to pay for this with my Bitcoin, and this thing that's going to cost me $10,000, I'm going to pay with my Bitcoin. But then literally 2 days later, when I go to pay for the thing, it's dropped 40%. And now
Right.
it's not 10,000 Bitcoin anymore. It's now, it's going to cost me 30,000 Bitcoin to buy that same thing because it's not stable enough as a currency anymore. So it's
Yeah, I mean,
lost that ability.
yeah, I mean, currencies in general have three different uses. They're a unit of measurement, okay, an accounting unit, which Bitcoin does fulfill that pretty well. Second, it's a store of value. Well, Bitcoin has some value because people are
People say it
considering it to
does.
be,
Yeah.
but it goes up and down so much that you can never transact in it, like you said. And then three, it's a medium of exchange. Okay. Well, you can't really go to your grocery store or go to your car dealership or even go to a real estate broker and buy with Bitcoin. You just can't do it. So it's neither a medium of exchange nor a store of value. And so, but it is an accounting unit. So in my mind, the speculators and the investors that got in and created this kind of volatility have kind of upended their own use case for using Bitcoin specifically. Okay. Now, but this applies to all other cryptos as well. Now, I'm going to separate Bitcoin from a couple of other trends that are happening. One is called tokenization. Um, and I've already talked about the unbanked. Okay.
Right.
Now we're going to talk a little bit more about the unbanked. Okay. Now, if we step outside the United States, there's a lot of unbanked individuals and households around the world. Okay. And there is a real need to have the ability to transfer assets quickly and inexpensively to those markets. Um, for example, one of the ways you can do that is by going to your bank and wiring the funds to an international bank in that country. Okay. Um, it's expensive,
Hmm.
cost you 25 to $50 depending on your bank to
Every
send it.
time.
And it's 25 to $50 whoever's receiving it. Okay. And then they convert the currency. And what you don't see is when they convert the currency, there can be anywhere from a 1 to 10% spread in that money. Okay. And that's where those banks and or payment processors make a lot of money. Second way, Western Union. Western unions are all over the world. You can transfer money anywhere. Okay. But also very expensive, takes a while, takes a day or two to actually get the money there. And they
And the
also,
person has to then go to the Western Union
correct.
office, right, in that other country.
Yes, they have to go to the Western Union and present a document that is exactly what you put on your sending. So again, it's expensive because they're converting the currency and making the spread. Okay. And then you're paying a little bit to send that money. I think using crypto or blockchain technology to transfer assets is a huge benefit. It's really great. All a person needs is a phone. So instead of having a bank branch in the middle of, the Congo or in the middle of Peru, you can, as long as you have your phone, you've transferred it within seconds and it's good to go. Okay. So I think that is an amazing use case. I think that's a huge opportunity. And that's
Mhm.
one thing that if I was wanting to get involved in cryptocurrency, that is something I would be pursuing that type of aspect. So the cryptocurrency I would be looking for is something that facilitates that kind of transaction. All right, so that's the unbanked. Second is tokenization. I think tokenization, what that means is essentially it's using blockchain technology to tokenize, i.e., you can buy a token, you can buy a coin or a token on a unique, real, or personal asset. I'm going to give you an example. So let's say Hannah and I want to buy the Mona Lisa. Okay. The Mona Lisa is a painting. Everybody knows where it's located. So we're going to go to the current owners. We're going to create this pool. We're going to buy it. Okay. We're going
Let's
to
see.
take in money. People
Us
are going
and
to,
8 friends. So there's 10 of us.
yep, 10 of us. So everybody gets 10%. So we all kick in money. We buy the pool buys the Mona Lisa. We then rent the Mona Lisa to the Louvre. Okay. For $1 million a year. Well, how do we know how much we own? Well, we create a pool and we tokenize the Mona Lisa. So now each of us own 10%. So that rental income of $1 million, we each get 100 grand a year. Okay. Now we could also create it as a token, as a quote unquote coin, and sell it on the market so that if people want to own a little bit of the Mona Lisa, they can. So we create a limited supply of coins on the blockchain and we start to have it transact on the crypto market. That's a tokenization. That is a way for people to invest in things that are more unique and more difficult to be on the financial markets. It's a painting. How do you trade a
Right.
painting, right? It's not a company, it's not there's no cash flow really based just on the painting unless you rent it like we did. So it's something that I think people have to understand. That this tokenization trend can go a lot further. Um, and this is my forecast, so take it for 2 cents or whatever. But I think all real estate transactions will eventually be on the blockchain,
Mm.
but they won't be anonymous and they won't be, um, actually, they could be anonymous to the public, but who will be creating the ledger and maintaining the ledger will be the state of wherever you live. Okay, so state of Arizona, the state of New York, the state of Nevada, who determines those rights will eventually have the blockchain. And that way you can trace back who's owned it, what dates they owned it, what prices were paid, and all that kind of stuff. It will be all on the blockchain because it's efficient, it's cheap, um, and good. So um I think there's a lot of use cases. So to me, facilitating financial transactions with the unbanked, massive, massive market, um, tokenization of real, unique, personal and or real estate assets. Okay, you can do that. And then, hold on. Just to let you know, I just looked up cryptocurrencies, 1% owners, 1% of the owners of the number of accounts own 90% of the cryptos.
Oh my gosh.
Yeah, so it's a really big concentration um, in ownership.
That's actually crazy.
No, it is because it's kind of you don't know how long they've owned it and what prices they've owned it at, and you can't tell where they're looking to sell out at.
Right.
So it's important to understand that this is, there's no use, there's no intrinsic value in these things. It's not like if it wasn't used to be a crypto, it'd be doing something else. There's
Right.
no other function for it. I was going to look up something. It was, hmm,
I don't know. I can't read your mind in this moment.
so I'll think of it in a second, but
Well,
um,
one of the things I wanted to jump in with there, when you were saying 1% of owners own 90% of did you say 90 or 99? 90.
90. So
90. 1%.
1% of the owners own 90% of the cryptocurrencies. So, for example, 90% of the Bitcoin are owned by the top 1%
That's great of holders.
of holders.
Yeah, whoever
Um,
holds it.
just for information, so the unbanked population in the United States is 4.2%, which is 5.6 million households. Um, but globally, it's 1.4 billion
Wow.
people. So just FYI, 1.4 billion is a lot of people. Just
Yeah.
in case you're wondering, it is an enormous opportunity for those cryptocurrencies to step in and to be the accurate, inexpensive, and quick payment transfers.
And there are some what we call stable coin, and maybe we can talk about that a little bit more on another episode, just so it's not like too heavy here. But there are stable coins that are working on things like that, or that have stepped into that space to be able to facilitate transactions where they don't move, right? Or they move very, very little, right? Like a fraction of a penny, basically. Which makes it, again, that's the stable part. But then that means if you put $1,000 into a stable coin, the purpose is that it's going to be $1,000 at the end of the year, and $1,000 next year, and $1,000 the year after that. It's meant to be stable and not move the way that other cryptos are moving. And you hit on one other piece that I wanted to just mention, again, because this is a question that I've gotten quite a bit, is, can people asking me, can you help me? I'd like to find those, cryptocurrencies that are going to take off. And I would love to be able to like be one of the ones who, makes millions of dollars on one transaction. And what I've found in researching this is that those meme coins, as they're called, or the new coins that are, that people put out, a lot of times they call them meme coins. It's all narrative driven. And so when something is narrative driven, that means it's literally just about the story. There's no substance underneath it. And those first people that buy in at the beginning of the narrative, the beginning of the story, are the ones that then spread the story. And then the price goes up. And the literal strategy is that when the narrative starts to reach far enough, you sell the coin, and the people who buy the story, buy the narrative at the end, experience the collapse. So they buy it high, then it collapses, and then it's gone. So of those 37 million, cryptocurrencies that exist, I would guess that most of those don't exist anymore.
Let's look.
Or like the life cycle, right? They literally have life cycles where they're like, oh, it was worth something at one point and now it's pretty much worthless, because it's, again, a narrative driven cycle versus a fundamentals driven cycle. And so I have never jumped on that bandwagon because I don't want to be a day trader. I don't want to be watching the markets every single hour to pay attention to what the narrative is and to have to buy and to have something that in order for it to be any sort of success, that I have to be paying attention every moment of the day or even pay attention like every hour, right? Like these things, like it moves really fast. And if you miss the narrative, you miss out, you lose everything basically. And that's how people are teaching how to trade these coins. So
It's
it's
a kind of pump and dump is kind of what it is.
exactly. I mean, we in the investment community, I mean, you're a CFA or charter holder, and they're like I'm also what's mine? APMA, accredited portfolio management advisor, right? Like we've been through a lot of education to understand how the markets work and how technical trading works and how all of that happens. And it's what I see happening there is that people are getting a little bit of education on how technical trading works in the stock market as a whole, and then taking that knowledge and applying it to crypto, and it works ish, right? If you hit it just right, but you're fundamentally, again, you're not actually trading anything that has, like we've been talking about, like value outside of what someone says it is. It's not like a Procter and Gamble that's literally selling toilet paper and razors and shampoo and billions of dollars worth of consumer goods. We understand why they make money, we understand how they make money, we understand when they make more money or less money, and that's why their stock price moves, right? This is We
Yeah, I
don't have
mean,
that insight with crypto
well,
because it doesn't exist.
for any of the asset classes that are kind of traditional in manner, um, there's always something beyond it. For example, commodities. Anybody can use a commodity to do something other than trade it. Okay. Real estate, for sure. Real estate something very different. It's easily understandable how you're going to make money or how you're going to lose money on it. It's a equities. You're buying
Right.
companies that do activities to generate cash flow. Okay. And bonds. It's a literal contract where a company or municipality or government entity is borrowing money from you. You know exactly how much you're going to make as long as there's no defaults. Okay. You can't do that with crypto. So it's something that's a little bit um it's just something that I think there are a lot of really great use cases for it. But trading it speculatively, just for those who want to do it, knock yourself out. But to me, it's a little more speculative because there is no other use for it as an investment. Um, for example, I mean, there's no reason, there's no intrinsic value in it, unless someone else says there is, unless someone else agrees to do that. Um, you know, it's something that I'd be kind of wary of. And if you do get involved in it, then keep it as a small percentage of your overall portfolio, just as a risk management uh, practice.
Right. And that's kind of where I wanted to land the plane also, is that we also acknowledge and realize that there have been people that have made a lot of money in cryptocurrency, in Bitcoin specifically, over the last, what is it, 14-ish years? When did it come out?
Mhm.
2011.
Yeah, around there.
So there have been a lot of people that have made a lot of money. I also personally know people who hit the trades wrong and literally lost all of their life savings, because f to your point, it wasn't okay, let me put 1% of my portfolio in there. Let me put, let me put a small portion in and see what it does. Instead, they're people that are hearing that narrative of, oh my gosh, this I've made millions of dollars, without having any of the rest of this context, and then putting everything they have into it. And that breaks my heart is what it does. Like it really pains me when I hear stories like that, because then that person is then like completely burned. And a lot of times they feel very burned by the entire financial market versus like, no, that was actually, you weren't informed as to how speculative that investment is and how wildly it can swing. You only heard the success stories. You didn't ever hear the balanced story that goes along with the whole thing. And so, again, when people ask me, I do not personally have a crypto wallet. I don't have any cryptocurrency personally. Just so I can be super clear on that. But if someone wants to do that, I tell them just keep it minimal. Don't don't put all your eggs in that basket, because the balance is important. Having other assets that are in other asset classes is always important, because you don't know what that one's going to do, especially because it is volatile.
Yeah, in fact, um, it it's important to understand that the use of the blockchain technology upon which all cryptos are based is a phenomenal technology.
Hmm.
Um, and the proliferation of that technology through the economy, which I think is going to happen. Like we own, so Juncture owns a lot of blockchain technology companies that are involved in that. Okay. But we don't own the crypto side. And the reason why is because we believe the proliferation in the blockchain technology will be not just in finance, but across the industry, pharmaceuticals, um, food, um,
Logistics, right? Shipping.
logistics, voting. All of these things are ways that the blockchain technology can really help the US and the global economy. Okay. But just because blockchain will be um, will proliferate throughout the economy doesn't mean that those cryptos will go up or down in value. So I'm having to separate the two and go, I really want to own the blockchain. I don't necessarily care about the crypto side of it. But again, as I've got clients that have um, for speculation, hey, I want to own 1% of it because I just want to be involved. Great, let's do it. We can do it for sure. Um, but again, I would just advise just keep it at a moderate amount. Don't go crazy because it is very volatile and we don't know what the end is going to look like for the cryptocurrencies themselves. Whereas I'm extraordinarily bullish on the blockchain technology of it.
Beautiful. Well, if you have any questions or any other thoughts or think we're completely crazy, every once in a while I'll get some YouTube comments that are super spicy and they're hilarious. So go ahead, leave all your comments. Seriously, it's pretty funny. People who disagree vehemently. But let us know. Let us know what questions you have, what thoughts come up, what you've been wondering about. We'd love to hear it. We'd love to respond. And well, it's the beginning of December, so hopefully everyone else is doing good, getting to work safely. It's snowy in some places, so be careful if you have to drive today. And we'll see you next time. Thanks, Brad. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.